looks a little bit light. The daily active users certainly not as bad as feared. The revenue increase of 7% in the first quarter. I should also note the slowest pace of growth for Facebook since that company went public in 2012. It brings the issue back to you, AK, on this notion of whether Facebook has reached its peak, if it can still grow its user base against what is a much different competitive landscape than it was when the company went public.
I don't think it's the peak necessarily, but it's going to be really tough. Every company, there comes moments where you have to reinvent yourself. Facebook right now is dealing with an issue where when you look at Snap, you look at TikTok, it's losing the youth. And the way that it's chosen to reinvent itself is through virtual reality. That's a bet that might take 5, 10 years to come to fruition. Meanwhile, what's the company doing? Where is it its attention when it comes to younger users? And that, to me, is the issue. I think that's probably the problem that we saw when the company's user base contracted. It's got to get them on. You ask them, where are they chatting? Is it WhatsApp? Is it Messenger? No, it's Snapchat. Where are they watching videos? Is it Instagram? No, it's TikTok. This is the biggest challenge for the company. And if people believe it's peaked, this is probably the reason why.
Yeah. Liz Young, in what is a tremendously big week, was Microsoft good enough? Is Meta, Facebook now good enough? And now everything, I guess, hinges on what Apple delivers. I know Amazon is important too, but the biggest company in the market, and especially what Qualcomm had to say. Now, Qualcomm, as John Fort said, may be Qualcomm specific, but nonetheless, you may get a little bit of a read-through through supply chain issues, chips and the like, and what's happening over in China. How do you see it?
Look, when we're talking about tech, this was the point I was in the middle of at the top of the show. I think a lot of people want to believe that earnings are going to pull us out of this, but earnings are not what got us into this. So at this point, the best we can do is that earnings create a floor on how much some of these names can draw down, and they create a floor on the market because we have those fundamentals to fall back on. But the reality is there are so many macro headwinds still in front of us in the next 60 days that the market is just hard to impress. We've been punishing beats by 1.7% on average, punishing misses by twice that. So at this point, yeah, they're good enough, right, to not create more damage. Earnings aren't piling on, and that's a good thing. But earnings are not going to be what solves all of our problems here, especially in tech and communications.
Josh, do you personally believe that the FANG? Go ahead.
I want to add to what Liz said. I think what she said is the key point, and it's so important. We don't have an earnings problem. We don't even have a revenue problem. We have a multiple problem. We started this year at 21 times forward earnings for the S&P 500. We are now down to 17.8 times. Where does it end? Does it end at 17? Does it end at 15? You go back through history, you try to find the impact of high inflation on the stock market. And one of the things that you notice is that actually earnings and revenue don't get hit that badly. And here is the reason. Judge, if you sell 100 refrigerators last year at $100 each, and then you sell another 100 this year at $1.20 each, because we're in an inflationary environment, well, it looks like your revenue is growing at 20%. It looks great. But people aren't paying the same multiple for your stock in that environment. So Liz has nailed it. And the only point that I would build on that with is we have a really interesting situation right now with both bonds and stocks down big to start the year. S&P down 13%. Barclays Ag down high single digits, which it's been like a long time since we've seen that.
42, I think. Some crazy stat like that.
Dude,
right?
It's bad. But
worst start to the year since 42.
It's bad. And that's right. And you go back 90 years. We have good data, 90 years worth of stock and bond returns. And here's what's interesting. There are only 4 years that end that way with negative returns for both stocks and bonds. In 2 of those 4 years, you had very high inflation, 1969 being a pretty good example, just to give people a sense. It's not the end of the world to have a negative year for both. It's just very unlikely. So we have Salesforce. We could see clients logging into their accounts. And I said to the head of my wealth management group, I said, what's going on with the clients, the logins? On the Dow, down 1,000 day. And he says, well, there is an uptick, not much. And I said, well, what are they worried about? He says, half of them are panicking about bonds, the other half are panicking about stocks. I said, all right, put them all in cash. I'll call them Labor Day. I'm joking. But like that's the environment we're in. Historically, one of those 2 things will win out. So we may have actually had a blow off top in bond yields, last week, which nobody's talking about. Highly possible. So stay tuned. One thing that everyone should keep in mind, and this is immutable, eventually the money has to go somewhere. So we may have seen the worst of the stock market correction if the whole thing is about multiple compression. If you tell me there's a financial crisis brewing, that's a different story, but we have no evidence of that. So I'm trying to stay constructive. Big multiple contraction already. Could be more, but earnings are holding up.
Yeah. Speaking of earnings, PayPal's out. Kate Rooney, what do you see there? Because this stock has been, man, it's been crushed.
Yeah, Scott. So in the first quarter, it looks like slightly mixed results here. Revenue was a beat, but PayPal with a significant slash here to full-year guidance. Let's start with earnings, though. Adjusted EPS, 88 cents for the last quarter. That was in line. Revenue coming in at about $6.5 billion, 6.48. Also a beat that was up 7%, and excluding eBay, revenue grew 15%. So eBay still very much a drag on growth over at PayPal. But when it comes to the full-year guidance, they're now looking at revenue growth of between 11 and 13%. For context, guys, 3 months ago, PayPal was looking at full-year revenue growth of about 15 to 17%. So slashing that number significantly. EPS outlook also lower than expected. For the full year, they're looking at a range that's now about 80 cents below where they were forecasting just a few months ago. Total net active accounts now at 429 million, and payment volume coming in at 323 billion, growing 13%. But again, the guidance and the slash to guidance really is the headline here. Back to you, Scott.
Yeah, and Kate Rooney, thank you. And not much reaction, certainly, in shares, which remain higher in the OT. Now, of course, all that can change in a matter of moments, and we'll pay attention closely to that. But Josh Brown, this stock is down 56% year to date. To say it's in the penalty box would be an understatement. It's like it got sent to the locker room, told to get dressed and go home. It's been so bad.
It's a disaster. It's actually worse than that. If you go back to the high of July 2021, this stock is down 70-something%. And let me put that in dollar terms. This was $300 billion in market cap, and now it's around $100 billion, maybe less. So they've lost $200 billion. Think about how many companies there are that are $200 billion in total market cap. That's how much PayPal's valuation has suffered. Where are the activists? Like, is nobody paying attention to this? Carl Icahn was involved in this when it was still a part of eBay. He demanded they spin it off. It worked. It was fantastic for shareholders of both companies. Where are the activists now? How could you have a company fall this far out of favor without the attendant deterioration in fundamentals? They still have 400 million users. It's not like the business fell apart. It just stopped growing. How could you have a market cap shrink to this degree and nobody steps in? Nobody questions the CEO. What are you guys even doing there day to day? Is anything taking place? So I think this is going to get really interesting the longer it stays down here.
You sound like an exasperated shareholder.
I'm not in it. I already got crushed in this stock. I'm out. Who is gonna step up and say, guys, what are we doing here, right? And I think there are a lot of fintechs, publicly traded fintechs, in the same boat, by the way. PayPal's just the biggest and most glaring, ridiculous situation.
The other thing, Josh, real quick before we take a break, and I'm purposely not including Liz in this part of the conversation, is, possible takeouts, possible deals, mergers between big banks who missed out on the fintech revolution from the organic level and now have no choice but to take a look at a PayPal, a Square, a SoFi, and that's particularly why I didn't include Liz in the conversation.
They can't do it. Almost none of these companies are making any money. They're all losing money. Like Robinhood is losing money hand over fist. It's what's called dilutive to earnings. You can't do a deal. You can't do a $100 billion deal for PayPal if you're a money center bank and take that kind of hit to earnings and then risk what the potential charge-off would be. And a charge-off is almost certain for most of these money-losing fintechs. So I think what's really interesting here is that people like Jamie Dimon and DJ David Solomon are going to start eating these companies' lunches. In the end, it turns out it's not that hard to hire engineers and build a great app. So if you think about what fintech will look like over the next 10 years, it's very likely that you'll see Morgan Stanley, JP Morgan, Goldman Sachs, Bank of America stage a little bit of a counter-revolution, and they have the capital to build really great stuff, and they are. So it's going to get a little bit, the disruption narrative gets a little bit tougher. And for PayPal, I do think they would be well served finding some more traditional dance partners, at least for joint ventures. I just think it's too big and too expensive to actually get acquired.
Let's go back to the Facebook story on Meta, of course, as well. Again, it was a top-line miss, bottom-line beat. Julia Boorstin just off the phone with that company's CFO. JB?
That's right. I just spoke with Meta CFO Dave Wehner, and he pointed out to me that the company had sequential growth in daily active users in each region, and that was improved on every region other than Europe. And they, of course, pointed out that Europe faced headwinds because of being blocked in Russia, being shut down in Russia, and also because of the war. But they point out the solid user trends on the Facebook side other than the blockage in Russia. So Europe was the one region that lost users. Now, on the revenue side, he notes that revenue fell in the midpoint of the range, very much as expected, and that it would have been higher. It would have been at the top end of the range or higher than that if it were not for the war. So very much worth noting here that they're facing the same headwinds that Snap pointed out last week. Now, in terms of Q2 total revenue guidance, he said that's the continuation of trends impacting revenue growth in the second half of the first quarter. The softness, he also notes that they expect to face foreign currency headwinds. I asked him about the impact of the operating system change that Apple, the iOS operating system change that has impacted their ability to target ads. He said they are continuing to work on privacy-enhanced technologies to deliver good performance for their advertisers, and they're investing on that front and also on AI and machine learning to build robust solutions for their advertisers that use less data. I pressed him as well on the impact of Reels. They warned last quarter that people spending more time on Reels was going to be challenging for revenue. He said, indeed, that does the growth of Reels. They're pleased with the growth of Reels, but that remains a headwind in terms of revenue growth because as time shifts to Reels, which has relatively few ads compared to services that are more mature, they do expect Reels to be headwinds to revenues near term in 2022. But going forward, they do expect more opportunities for Reels going forward. Guys?
Okay. Julia Boorstin with the update there. Thank you. You can see the stock in the OT up better than 13%. This smells to me all about DAUs. You can take all the other numbers out of the picture after what happened last time. Then the fact that DAU growth improved in every region, Alex, is what this story is about today.
No doubt about it. There's no other way to look at the reason why the stock is moving as high as it is right now.
I mean, when your guidance is below, when your revenues miss and the stock's up 13%, this to me says gigantic sigh of relief on the active users, on the daily active users, that story isn't in fact over, that it was just perhaps a blip.
Yeah, well, investors also kicked the crap out of it in the last quarter. So, they probably punished it too hard. There's a lot of reason to try to run away from Facebook, right? You know all the headwinds that are coming at it. TikTok, you have inflation, you have the war in Ukraine, you have supply chain issues, you have struggles with direct-to-consumer brands. So if you're an investor, you have all that in your head, and then they're shrinking. Yeah, you got to get out there. So the fact that it's a bit of a dead cat bounce, right, on this one, where they're now saying, okay, we're going to give it another chance, but not too many of them. Yeah. So we'll see how it plays out.
Is that the story, Josh? It's all about the DAUs? I mean, I'm getting a comment from a money manager who says much better than the buy side feared, and maybe that sums it all up too.
Yes, very important. And the thing with Reels, don't underestimate the Reels story. They absolutely have to take the wind out of the sails of TikTok. Like, this is almost existential for Instagram and the younger demographics. And actually, as a creator, when you post a video to Facebook, if you can keep it under a minute long, you're better off making it a reel than you are making it a story or a regular timeline post, because Facebook is so desperate to build up reels that they are substantially rewarding you with viewership of that video. So now you're seeing a lot of creators pivot content that they ordinarily would have uploaded in a different format to that Reels format. Like, everybody is doing that. So it's really important as a shareholder to see that they are responding to that new format's popularity in the market and all of the ad revenue that can come from building it up.
I got to go to Bertha Coombs because Teladoc is going to develop into quite the story in the OT. Bertha, what do we see here?
Well, we're seeing a huge drop in Teladoc. It's hard to do an applicable on the bottom line, but on the top line with a miss at $565.4 million. And they are lowering their outlook for 2022, now looking at a net loss per share of $43.50. That's EBITDA, earnings before interest and depreciation, revised to 2.4 to $2.5 billion on revenues of $240 to $265 million. Among the issues, they said, is that they are experiencing some headwinds when it comes to chronic condition market. That's what they bought Livongo for, and one of the areas that they are really trying to grow because it does include more revenue. Part of the issue there is that you have to engage the members to sign up. They don't get it automatically from employers. The other issue in the direct-to-consumer market and the mental health market, which has been growing, and they are seeing growth, but they are having to spend more on advertising, whether it's sponsoring podcasts or going direct to consumers online to get them on. And as you can see there, that stock now down more than 30% after hours. A conference call starting at 4:30, but very much a rough haul here for a stock that was already down 70% from its 52-week high coming into this afternoon's print.
Yeah. All right, Bertha, appreciate that very much. That's Bertha Coombs with Teladoc, a disaster in the OT. Stock's down more than 38%. Huge position for Cathie Wood, one of the biggest blow-up positions that Jim Cramer has ever seen. That's what he's telling me. Josh Brown, I don't know what stock you want to pick. Peloton, Netflix, Teladoc, the world's different. The world is different today, and it's going to be even more different tomorrow and the week after that, and stocks like this are going to suffer.
Yeah, I mean, this Teladoc thing is going to be really tough. You know, this was a stock that was working prior to the pandemic, and they just had this tremendous pull forward in awareness and demand and usage. And when the stock price was at its height, I think they had a really smart notion. They said, we better diversify this business and figure out something else to do and not just rely on the growth of video doctor's appointments forever. And we got to use these inflated share prices as like a currency. And so they tried. They did a diabetes monitoring thing, but I think the market looked at that and was skeptical. So this was one of the first of the, quote, stay-at-home stocks to start blowing up. This has been blowing up for over a year now, and I really don't know what to say at this point. This is a big weighting in a couple of the ARK ETFs. ARK might be the biggest actually institutional shareholder. Yeah.
That's exactly what I was saying about the size of the position that, you know, ARK, Cathie Wood had in Teladoc. And, man, I mean, that is the second derivative story of this story, what's happening in Teladoc. And we'll get into that. But we're going to take a quick break. Big thanks to Josh Brown, Liz Young, Alex Kantrowitz. Thanks for being here on set. It's always good to have you right here. We will be right back.